Imagine locking your money away in a vault, expecting a payout in 5 to 7 years, and then the door simply refuses to open. That is precisely the situation facing European private equity firms today, the 16th of July, 2026. Reports published this morning confirm that the exit backlog across European PE has reached its highest point in a full decade. We are talking about hundreds of billions of euros worth of portfolio companies sitting on general partners' books with no clear route to sale, IPO, or secondary transfer. This is not a minor blip or a seasonal slowdown. This is a structural logjam that has been building for 2 years and is now at a critical pressure point. In tonight's video, we will explain exactly what is driving this backlog, name the firms most exposed, and tell you what it means for investors, pension funds, and the wider European economy. Before we go further, let us be precise about what an exit backlog actually is, because the term gets used loosely. When a private equity firm acquires a company, it typically plans to sell that stake, through a trade sale to a strategic buyer, a secondary sale to another PE fund, or a public listing, within a defined holding period, usually 4 to 7 years. An exit backlog forms when those planned disposals cannot proceed on schedule. The firm is left holding assets longer than intended, capital is tied up, and the promised returns to investors are delayed. For European PE, the backlog is especially consequential right now because the region's buyout firms raised record amounts of capital between 2020 and 2022, deploying it aggressively at high valuations. Those assets are now maturing simultaneously, all competing for the same narrow set of exit windows in a market where buyers are scarce and valuations are under pressure. The roots of today's crisis trace back to a confluence of factors that McKinsey's February 2026 analysis described as clearer view, tougher terrain. First, rising interest rates through 2023 and 2024 compressed valuations across virtually every sector, meaning PE firms that bought at peak multiples could not sell without crystallizing a loss. Second, the IPO market across European exchanges remained largely closed to large-cap PE-backed listings. The conditions that made the 2020 and 2021 listings boom possible have not returned. Third, strategic acquirers, the corporates that typically absorb PE exits through trade sales, have themselves been cautious, managing their own balance sheets amid sluggish European GDP growth. PitchBook's reporting on EQT's situation as far back as February 2024 flagged this asset pileup building specifically at Scandinavian and pan-European firms, and the problem has only deepened in the 18 months since. The result, holding periods are stretching from a typical 5 years to 7, 8, or even 9 years on some positions. EQT, the Stockholm-headquartered giant, has been among the most prominently discussed names in relation to the pileup. Its diversified portfolio across infrastructure, real estate, and buyouts means it has a large volume of assets simultaneously approaching or exceeding typical holding periods. But EQT is far from alone. The broader European mid-market and large-cap buyout landscape, encompassing firms operating out of London, Paris, Amsterdam, and Frankfurt, is facing the same structural pressure. Bain & Company's review of the healthcare private equity market, published in January 2025, noted that healthcare-focused buyout portfolios were among the most illiquid, with sponsor-to-sponsor secondary sales down sharply. Given that healthcare represented one of the largest allocation themes for European PE in the 2020 to 2022 vintage years, this compounds the overall backlog considerably. Firms with heavy exposure to consumer discretionary and technology are in a similar position, as those sectors have seen buyer appetite soften most sharply. The people who feel this backlog most acutely are the limited partners, the institutional investors who committed capital to these funds. We are talking about European and North American pension schemes, sovereign wealth funds, university endowments, and insurance companies. These institutions allocated to private equity precisely because they expected distributions, cash returned from exits, to fund their own liabilities and commitments. When exits stall, distributions dry up. A pension scheme that expected to receive a significant cash return in 2025 or 2026 from a 2018 vintage fund may now be told that return is being pushed to 2027 or 2028. This creates what is called a denominator effect in reverse. Institutions find themselves overallocated to PE not because markets fell, but because the private assets simply cannot be moved. Some limited partners have turned to the secondaries market to sell their fund positions at steep discounts, sometimes accepting as little as 80 pence on the pound, just to restore liquidity. The backlog does not just affect spreadsheets and fund returns, it has real consequences for the businesses and employees sitting inside these PE portfolios. When a holding period extends unexpectedly, portfolio companies often face pressure to perform differently than originally planned. Management teams that were preparing for an IPO roadshow or a sale process find themselves in limbo, unable to make the long-term investment decisions that strategic certainty allows. In some cases, PE sponsors push for dividend recapitalizations, essentially loading the company with additional debt to return cash to the fund, which can weaken the business's balance sheet at precisely the moment it needs resilience. Workers at these companies face uncertainty about ownership and strategy. In sectors like manufacturing and business services, where European PE has deep exposure, this kind of ownership uncertainty can stall hiring, suppress investment, and create churn at senior leadership level. So where does this go from here? The honest answer is that there is no quick fix, and anyone suggesting otherwise is not being straight with you. The most credible near-term relief valves are threefold. First, the secondaries market, where specialist buyers acquire PE fund stakes and direct assets, is growing rapidly in response to the backlog, with several large European secondary funds now raising capital specifically to absorb distressed or delayed exits. Second, continuation vehicles, where a GP transfers assets from an older fund into a new vehicle with a fresh clock, are becoming increasingly common, though they require LP consent and can be contentious. Third, a meaningful recovery in European public equity markets and a reopening of the large-cap IPO window would provide the most comprehensive release, but that depends on macroeconomic conditions that remain uncertain. McKinsey's assessment that 2026 represents tougher terrain appears well-founded. The backlog is unlikely to clear meaningfully before 2027 at the earliest, and that assumes no further deterioration in credit conditions or buyer sentiment. This exit backlog has implications that extend well beyond the PE industry itself. Europe has long grappled with the challenge of building deep, liquid public markets capable of absorbing large-scale listings, a point that was raised sharply in a Fortune analysis from September 2025, which argued that Europe needed to build better public markets for growth companies rather than chasing speculative cycles. A functioning PE exit ecosystem, particularly through IPOs, feeds directly into the health of those public markets. When the PE pipeline is blocked, fewer quality companies come to market, retail and institutional investors have fewer opportunities, and the broader ecosystem for growth capital weakens. For British investors specifically, the implications of a decade-high European PE backlog matter given the deep cross-channel fund relationships between London-based managers and continental European assets. The city's role as a hub for PE fundraising and deal structuring means these pressures are felt domestically even if the underlying assets sit in Germany, France, or the Nordics. Let us bring this together. As of today, Thursday the 16th of July, 2026, European private equity's exit backlog stands at its worst level in 10 years. The causes are structural. Peak cycle valuations from 2020 to 2022, a closed IPO window, cautious strategic buyers, and stretched holding periods. The consequences are real: constrained distributions for pension funds and endowments, financial pressure on portfolio companies, and a broader drag on European capital market dynamism. Relief will come through secondaries, continuation vehicles, and eventually a recovery in public markets, but not quickly. If you are an investor with exposure to PE, or you work inside a PE-backed business, this is the environment you are navigating. The backlog is the defining challenge for European buyout firms right now, and understanding it is the first step to making sense of what comes next. Thank you for watching. If this analysis was useful, please share it with someone who needs to understand what is happening in European PE today.